Hi, and welcome back to It's Your Move, where we talk about all things real estate, including where I live and work in Galveston, Texas. Speaking of Galveston, you should check out some of the upcoming events. We always have festivals and events that involve food and fun, and who doesn't like that, right? So check it out. Anyway, today let's talk about preparing to buy a home. Most people are either thinking about it or planning it, or they get so busy and things happen really quickly. So let's talk about preparation. Buying a home is a huge accomplishment, but the housing market really can be competitive. And that's especially true when it comes to mid-price and affordable homes. That's the really competitive area. Preparation is key, and the most prepared buyers have the best chance at beating the competition. So here's what you can do. When you're preparing to buy a house, the earlier you can get started, the better. Working on your finances in the months prior to buying a house will certainly improve your budget and your mortgage options. But even if you're ready to buy now, there are some steps that you can take that will help you along in the home buying process. This will be an overview of what you can do to prepare to buy a house pretty much in chronological order. If you're in the early stages, if you're a first-time home buyer and you're in the early stages of home shopping, you are way ahead of the game. While you're touring open houses, you can get your personal finances in order and collect any necessary documentation. Because let's face it, there's always documentation, right? If you need a loan to buy a home, you can get ahead of your credit, your debt, your savings, which means you could have a bigger savings. You could maybe afford a bigger home and have a better budget when trying to find a home that's right for you. So you have more options. Now, these 4 steps can help you prepare to buy a house when you're still getting ready for home ownership. First, you want to check your credit. Once you decide to buy a new home, the first thing you need to do is check that credit history. This involves reporting credit reports from each of the 3 credited bureaus, Experian, TransUnion, Equifax, and this will help you better understand your credit score. Now, your score determines whether you're eligible for a mortgage, and it influences your mortgage interest rate. The higher your score, the lower your interest rate in most cases. Both a higher credit score and lower interest rate will save you money. Most mortgage programs require a minimum credit score between 580 and 620. Ideally, you should check your credit history at least every 6 to 12 months before applying for a mortgage loan. This allows you to have time to improve a low credit score if that's necessary. Yes, there are steps you can take to improve your credit score, which will be discussed on a different day. You should also check your credit reports for accuracy and dispute any errors, especially negative errors that may decrease your score. Because remember, errors, we're all human, so people make mistakes. So, the people who are reporting your credit or recording those things can make mistakes. So the smallest error can have the biggest impact on your ability to get a loan, and that will lower your, a better loan, better interest rate. Make sure you don't have any errors. So to get your credit report, contact each of the 3 bureaus separately or all 3 copies from an annualcreditreport.com. Normally, you're entitled to 1 free credit report each year from these bureaus. And I'll link it, put a link down in the description for you for that, so you can get your free annual credit report. The second step is to lower your debt-to-income ratio. Your debt-to-income ratio is the percentage of your monthly gross income that goes towards debt repayment. Mortgage lenders use DTI, debt-to-income ratio, to see how much of a house payment you can actually afford. Typically, lenders prefer a DTI ratio that's no higher than 36 to 43%, depending on the mortgage program. For example, let's say you have a gross monthly income of $4,000. Your monthly debt payments include a future mortgage payment, okay? And it shouldn't exceed $1,720. Your DTI is 43%, which is 1,720 divided by 4,000, which equals 0.43. or 43%. Some mortgage lenders allow a higher DTI ratio when a borrower has compensating factors, such as a high credit score or a large cash reserve. In other words, a strong credit score or a healthy savings account might compensate for a high DTI. So you have a couple of options that way. Now, to lower your debt-to-income ratio, or DTI, pay off as much debt as possible before applying for a mortgage. This includes credit cards, auto loans, student loans, and other loans. You may also pick up a side hustle or part-time job to increase your income, which will also improve that DTI. Now, you don't have to be debt-free to purchase a home, but the less debt can be a purchasing power for you. And you need all the leg up you can get, in the market these days. So let's talk about number 3, which is save for a down payment. Unless you have a VA or USDA loan eligibility, you need to make a down payment. Conventional loans require 3 to 5% down, and an FHA loan will need at least 3.5% down. So if the purchase price for your first home is $400,000, you may need at least $12,000 to $20,000 as a down payment. You're also responsible for closing costs, which are roughly 2 to 5% of the loan amount, or $6,000 to $15,000 on a $300,000 loan. So when applying for a mortgage loan, your lender will ask for copies of your bank statements to confirm you have enough cash reserves for your down payment and closing costs. If you don't have enough cash, some mortgage programs allow borrowers to use gift funds, or funds from family, friends, gifts, funds. And so check with your lender about the specifics for gift funds if you're going to be using that or might need that. Of course, you should still have some sort of income. Money in the bank can be spent and no longer available when closing day arrives, or the mortgage payment is due. So banks still expect you to have an income on a regular basis to repay the loan. There are also loan payment assistance programs, or DPAs, in every state. These offer grants or loans to qualified home buyers who need help with their down payments. So if you need a little extra help with your out-of-pocket costs, ask your loan officer about local DPAs for which you might qualify. And finally, step number 4, determine your budget. I know nobody wants to talk about the budget, but before meeting with a mortgage lender, use an online mortgage calculator, because there's a lot of them, and estimate how much you can afford to repay on the loan. Once you know what your home purchase price range will be, you can gauge how much to save for a down payment and closing costs. For example, if the calculator says you're likely to afford a $300,000 home, aim to save a minimum of $15,000 for your down payment and perhaps another $6,000 to $9,000 for closing costs. Now, estimated home purchase price, $300,000. 5% down payment, which is typical for a conventional loan, is $15,000. So estimated closing costs would be $9,000, and the minimum amount to save would be $24,000 on a $300,000 loan for its conventional loan. Now, mortgage calculators do vary. Some estimate your monthly payment based on the home price, down payment, interest rate, loan term, and other monthly mortgage expenses like homeowners insurance, property taxes, homeowners association dues. There's a lot of things that can factor into the calculator. Other calculators, however, estimate affordability using the information that you provide about your income and current debt payments. But remember, that is only an estimate, and you still need to contact a mortgage lender to learn how much you really qualify for. So I'll put a couple of links down in the description to help you figure out what you can afford, and that's all we have for today. I hope this information was useful. The next video, we'll discuss preparing to buy a home when you're ready and you're not in the early stages. So thanks again, and remember, it's your move.